Hi, everybody. Welcome back to Healthy, Happy, Wise, Wealthy. We have with us today Haren Bhakta of Inside Ownership Index. So thank you for being here. And before we start, I want to say we have a podcast sponsor, Mindy, Mindii, which is a basically everything in the IT background that you got to have for your businesses to run. They can pretty much do it all, full stack websites and all the IT stuff that I honestly I don't understand too much, but they make it happen. I feel like a lot of us don't understand IT very much. Probably similar to what you're doing.
Yeah.
So
I,
for
I
sure.
I I don't understand IT either.
Yeah. So, Inside Ownership Index. So, today we're talking about basically the stock market and investments. And so, you guys do things differently from what I'm seeing on the website, in that, and I'm going to have you explain this because I'm sure you'll do a better job than I could do trying just seeing what you do on the website. But you're following the owners of the businesses and the leadership and kind of following how they're investing. Is that a good overview?
Yeah, well, not exactly how they're investing. It's more
Okay,
so um, how much they own of the company they lead.
that makes sense.
Yeah.
So, okay, so when someone works with you and you take over their investment profile, what changes do you usually make uh, with that in mind?
Yeah. So I don't actually work with individuals. I work with financial advisors. So
Oh, okay,
yeah, what we
okay,
created is an ETF,
okay.
an index fund ETF.
That's interesting. So tell everyone what that is, for anyone who doesn't know what an ETF is, for
Sure, an
anyone
ETF
who's
is
just,
Yeah,
yeah,
an ETF is an exchange traded fund. It's basically an index fund. So there's a lot of low cost ETFs out there. There's also actively managed ETFs, which means they're not index funds, but someone's actively picking stocks within the ETF. So you could purchase an ETF just like you purchase a regular stock, except this ETF, it tracks a group of stocks versus just one.
okay,
Yeah, and the most famous ones are, for example, Vanguard, S&P 500. So you could buy all 500 companies within the S&P 500 by buying just one stock, and typically they're very low cost to do that. So you get broad exposure to the stock market. For those people who don't know how to pick individual stocks, to be honest with you, most professionals, including me, don't know how to pick the best stocks over a very long period of time, and we're just better off buying a passive index fund.
okay. That makes sense. So what you do is different from what is normally done on the S&P?
Correct. The
Um,
S&P 500 is essentially the 500 largest companies in the United States. And the way they decide how much to put in each one of those 500 is by size. So the S&P 500 is what's called market cap weighted, meaning that the bigger the market capitalization, the more they invest in those companies. I created something, uh, a similar concept, but different in terms of how much we allocate to each company. We allocate more when the leadership of those organizations own more. So we proportionally allocate to those companies based on their ownership. So the idea is we want skin in the game, we want symmetry, we want accountability, we want to invest in companies where leadership really cares because their own money's on the line. And
yeah.
yeah, and by doing that, we figured out that the group also has performed better over a very long period of time.
Well, then that makes a lot of sense. So on your website, I was reading that that isn't how it seems like that's how it should be done, but what I was reading is that it isn't. So for example, if someone who owns a company sells their share, that is like not included, like the billionaire class, whatever they do is not included. Um,
Right. So this is called free float adjustment. So this is what the S&P 500 does. So I could tell you how I thought of the idea and incorporate that with that adjustment.
okay.
So, so I'm a huge Warren Buffett fan, and I've been reading everything he puts out for a very long time. I've attended every annual Berkshire meeting where about 40,000 people go and see him speak and ask him questions. I've been attending that live since 2017, and
Okay.
I invested a lot when I was working with individuals and myself. I purchased a lot of Berkshire Hathaway for my clients and for myself. And in 2024, I was at the meeting, and this is the first meeting without Charlie Munger because he had passed away. So I
Okay.
just kind of had it in the back of my mind, some kind of fear. What am I going to do with my Berkshire shares when Warren Buffett dies? And I'm sitting there thinking, I don't think the economics of the company could be as good without Warren Buffett. I mean, he created the company. People sell their companies to Berkshire because they want Warren Buffett as the owner. So it's like the opportunities they get, also the future opportunities also come from Warren Buffett's leadership. And Greg Abel, the new leader, he might be great, but he's not going to get those type of opportunities. So anyway, I'm sitting there actually afraid, and someone asks Warren Buffett a question in the middle of the meeting, and that's when it hit me. The S&P 500 will actually be buying more Berkshire Hathaway when Warren Buffett dies, and that's because the S&P 500 is what's called free float adjusted, meaning when they look at the size of each company, they actually exclude the shares held by controlling shareholders. So they're not count. So Berkshire Hathaway is $1 trillion company, but they're only counting it as a $800 billion company, and they're excluding the 200 billion of Berkshire that he owns. But when he dies, those shares will be distributed to foundations and sold ultimately and become free floating. So the market cap will expand upon his
Okay.
death. And I just thought to myself, well, why would anyone want to own more Berkshire without Warren Buffett? And in fact, I would want to own far less. And the same thing can be applied to almost any company. Why would anyone want more Tesla without Elon Musk? Why would anyone want more Amazon without Jeff Bezos, right? These are great companies that these great leaders have built. So it's kind of a thought experiment to yourself. You have this great company built by great leaders. Now, overnight, we go and replace all the great leaders with new people. Like, would you call that the same company? And would you attribute the future success to that organization without those leaders who built it? And, you can look back at history, and almost every organization starts to erode once those leaders are gone. And the example I have for something that's top of mind is Nike. Currently, Nike is down about 50% over the last 5 years, or 5 6 years since COVID, when the stock market is up drastically, and Phil Knight is retired completely, and the company is going through a downturn. Same thing with Starbucks, right? Howard
Interesting.
Schultz also retired. Uh, so, the best examples I have are even further back in history, which we can go through if you want to.
Yeah, we can.
Yeah, yeah. Well, I mean, what I ask people is, what is the most dominant company in United States history? And when I say dominance, I mean relative size to the next largest companies in the world. And the answer to that is IBM. IBM in
Okay.
1984 was more than 2.5 times larger than the next largest company in the entire world. So this is incredibly dominant. This would be like Nvidia being a $12 trillion company today. right? Because
Okay.
the next largest company would have to be 2.5 times smaller. So this is extreme dominance. Now, a lot of people don't know this about IBM, but Thomas Watson Sr. was the founder in 1911, but it was actually his son, Thomas Watson Jr., that took him public in the 50s and 60s, and he ran it as CEO until 1971. But he retired from the board in 1984 at peak IBM. And fast forward just 8 years, by 1992, IBM was not even in the top 10. So you're talking about the most dominant company in the history of the United States loses its dominance in 8 years once those responsible for its success have retired. Um,
Interesting.
yeah, and another example I have is Intel under Andy Grove, the longtime CEO from '70s. $10,000 invested when he became CEO of Intel would be several million by the time he retired in 1998. 1998, fast forward to today, it's almost zero returns. So, this is what happens when those responsible for success of an organization retire. They're not the same company. Um,
Yeah.
Intel had 90% market share in the PC microprocessor business. This is the dominance that Andy Grove created. He even wrote a fantastic book called "Only the Paranoid Survive." It's about strategic inflection points of what companies go through and the decisions they have to make and staying on top. And it's a classic example of some of the big decisions they made. They actually left the, I believe it was the memory market. They were making memory chips and they pivoted. And it's one of the best pivots in corporate history. But um you know these are classic examples of what happens. The only exception I could find where a company has continued to do extremely well post founder, or not post founder, but post owner, or post uh leadership that created this success. It doesn't have to be a founder, but Apple had continued to do well despite Steve Jobs passing away. That's the only
Okay.
exception I could find. But an argument can be made also that Apple also has not innovated anything new post Steve Jobs. They've grown the iPhone business really well. They've made the iPhone better, but they haven't made any AI investments, and I don't know if they're going to participate in the next wave of innovation to come.
Yeah. That's
Yeah,
very interesting. Well, it does make a lot of sense that you follow the leadership and see where they're investing, and I think
yeah,
there's some laws for insider trading, but
yeah, yeah,
I don't know that
yeah.
they it doesn't seem to matter from what I can tell,
Right. Well, yeah, and to add some clarity to that, we're not actually following the activity. We're not following the buying or selling of stock as much. We're actually looking at the ownership. So,
Okay.
for perspective, Jeff Bezos has been selling Amazon for 20 years. Jensen has been selling Nvidia for 20 years. So we're not following the fact that they're selling their stock. They're just taking liquidity as any founder has. We're overweighting their position in our index because they own so much of it. So it has more to do with the ownership than the fact that they're selling. If we
Okay.
focused on the selling, you would miss those stocks, right? Um, but because they own so much of it, they represent a bigger piece of our index
Yeah.
versus an S&P 500 index.
Okay. So you really are focused on the S&P. So tell me,
Correct.
for people who don't know the S&P that well, I don't even know that I do, honestly. Does it change the companies that are in there? Is there a regular?
Absolutely. So every
Okay.
quarter the S&P 500 is rebalanced, and I believe every year they uh, update the position. So there's a committee that gets together and decides, what companies should be included in that 500. So it's around the 500 largest companies in the U.S., but there's some wiggle room there where they may choose one company over another with similar sizes. So what they do is try to have a rule where a company has to be profitable for a full calendar year before they include that company into the index. And but all the super largest companies are all in the index as long as they're publicly traded. Some new ones that are going to be joining the index at some point are like SpaceX, Anthropic, and OpenAI. So it's very interesting. The largest companies in the U.S. in the S&P 500 are going to be companies that were pretty much all founded in our lifetime. And when you look at other countries like Europe, well, if you look at the largest companies in Europe, they were all founded in 1920s.
Mm.
And you could see that, Europe has experienced no growth, no big innovation. This is because it takes true ownership to innovate. All the competitive advantages that legacy companies have with size, but still, you're looking at the biggest companies in the U.S. You know, companies that were born in our lifetime by founders who are still running them today.
Yeah.
So this is the importance of really identifying companies where leadership, um, those responsible for the initial success, are still there innovating.
Yeah. Well, that makes a lot of sense, honestly. It doesn't
Yeah,
actually make sense that that isn't considered.
yeah.
So you started this EFT in ETF.
ETF,
ETF.
ETF. Yeah,
ETF. See, that's how little
yeah,
I follow
yeah,
this stuff. ETF.
yeah.
Uh, in 2 years ago, just 2 years ago.
Well, the index itself that the ETF is tracking was launched 2 years ago in 2024. The
Okay.
ETF itself became actively traded now, so just very recently. So the ticker symbol for that ETF is OWN, own.
Okay.
So
Oh,
it's a
that's
very
great.
easy yeah, it's a very easy
Okay.
ticker symbol for people to find.
So it's just this is brand new offering for people to get in to use it. It wasn't available 2 years ago. It's just now something people
Yeah,
can buy. Okay, so it's brand
exactly.
new.
It's brand
Oh,
new. Yeah. Oh, well,
awesome.
the index has been around for 2 years that the ETF is tracking, and we've been managing portfolios, tracking that index for almost a full 2 years now. But uh, now it's available to anyone without working directly with us. So in the past, we had to manage the client portfolio ourselves and purchase the stocks for each individual client. Now, anyone can go and access the strategy via an ETF.
Okay. Well, that's very helpful, I'm sure, to a whole lot of people.
Yeah.
So tell me how it's performed in the last 2 years versus uh,
Yeah, well,
the S&P 500.
the market has done very well. Yeah, Inside Ownership 100 has done even better than the S&P 500 over those 2 years since launching it. What's interesting is, going back, we also back tested it 20 years. And it's not some complicated algorithm. Is simply looking at the ownership of the leaders and allocating the portfolio to proportionally to their ownership. So we're able to go back as far back as we can get the ownership data, and we're able to get 21 years of it, and we could compare that with the S&P 500, and they outperformed the S&P 500 by basically 300%. So
Oh, wow.
$10,000 invested in the S&P would have produced around 700% over that 21 period, 21-year period. So $10,000 turned into about $70,000. Um, 10,000, same $10,000 investment in the IO 100 would have produced about $110,000. So uh,
That's better.
yeah,
That's
close to
significantly
300%
better.
more cumulative
Yeah,
percentage points better. Uh, but what's also interesting is now it's also more volatile. So it has bigger ups and downs through time because it has more concentration. It has more exposure to some of the best companies, which makes it very concentrated. But I'd like to add that in 2008, the great financial crisis and COVID-19, what we could call those the two global catastrophic events we've had in the last 20 years. Um,
hmm,
the inside ownership companies went down less than the S&P 500 did. The S&P 500 had a worse drawdown during those two periods.
okay,
So that's very interesting to me is that when you needed safety the most, it held up better.
yeah. That's a good metric to look at for
Yeah,
sure.
yeah.
So with the ETFs, just if you could educate us a little bit more, is this something that, someone who feels like they can do their own trading can access? Should you be working with an investment advisor, which you probably should? But where's the what's your wisdom on that? So if someone just is like, I'm going to do some of my own investing, can they go pick different ETFs for that?
Yeah, well, it depends on why you're using a financial advisor. Now, if you're using a financial advisor to go and pick individual stocks for you and thinking that they're gonna, make you rich or perform better than the S&P 500 or the stock market in general, I think that's a huge mistake. Most 90% of active stock pickers don't beat the index, and it's a very small number that
That's
really
crazy, really.
beats it. Yeah, beyond 15 years. So it's almost like 1 out of 10 people might beat the index over a 15-year period, and it's almost impossible to tell which one of those 1 out of 10 will do it. So you're much better off investing in an index fund. Now, one great thing about financial advisors is they can keep you thinking long term, keep you invested when it's very difficult to stay invested. The market creates a lot of emotions. The market goes up and down, and when you have periods like 2008 or COVID-19, it's very easy to make the wrong decision and sell at the wrong times. So
Yeah,
that's the one benefit of having a financial advisor. If you could have someone hold your hand and keep you invested, uh, but that job is expensive, so you're paying 1% per year, sometimes more with some advisors. But I would recommend not having an advisor that charges more than 1%.
okay.
But if they can keep you invested, it's well worth it. If you're able to invest and not look at it, you don't need an advisor. You could just purchase ETFs on your own
Okay.
and stay invested for the long term. So I think you have to know yourself, really. Do
Yeah,
you make emotional decisions when things get tough?
it seems like everybody does, let's be
Yeah,
honest,
yeah,
you know?
yeah, yeah.
Yeah,
So if you could hire an advisor
yeah,
to really keep you focused on the long term, you know, the it's honestly worth the money.
yeah. It does seem like uh, making money sometimes is a matter of, in investments, is a matter of buying when people are selling and selling when people are buying. Uh,
Yeah, yeah, yeah. Although that again is timing the market. I like to say, um, just keep buying, and keep buying. And when the markets get cheap, you buy more. So right now the market is very expensive. So um, you may not be buying right now, but you should be holding what you already have,
Hmm.
right? And be allocating uh, excess money to maybe more conservative type investments. And when the stock market gets cheap or goes down by maybe uh, 10, 15%, you could start adding more money in. And as the stock market gets cheaper, or goes down more, you could be buying a lot more. So there is a benefit of having a financial advisor to kind of guide you through that, basically.
Yeah. And there's, yeah, and then I know there's other things financial advisors do also just to kind of keep you balanced and everything you need.
Exactly.
Yeah, for sure. So if someone wants to, or like, they're like, maybe I do want to start doing some trading on my own. Do you have any advice on how to start?
Well, I would highly recommend reading Warren Buffett's letters, or listening to his annual meetings. They're all on YouTube. So you could
Okay,
search Berkshire Hathaway annual meeting, and I would listen to the ones in the 90s. That's where Warren Buffett was at his best. And if you can get a
okay,
general philosophy on investing in stocks, if you could start treating stocks as you would maybe an apartment building that you bought, right? When you buy an apartment building, you're worried about rents covering your mortgage and things like that.
mhm,
You're not seeing a price for your building available online every day. And the problem with stocks is you start seeing a price for it flash on your screen every day, and you think of selling when it goes up a little bit, and buying a little bit more if it goes down, or maybe the reverse for some people. But you have to treat it like you would in an apartment building, and really not look at the price, and really focus on how the actual business attached to that stock is doing. So, is the company growing revenues and performing better than it did the year before? Is the business getting stronger? You start paying attention to those things and not the stock price. And that's how
yeah,
real wealth is made, because you're able to hold these stocks for a much longer time. Real wealth is made in the stock market by holding great companies for a long time.
okay,
That's how you get wealthy.
yeah. So with your index, if there's 500 companies in it, do you guys look at the ownership for all 500, or
So
is
we
it
look
more
at we
geared
look
towards the
at
top?
yeah. So we look at the S&P 500. We look at the ownership of all 500, and then my index that we created will invest in the top 100 from the S&P 500, based on um, the top dollar value of essentially skin in the game. So those leaders that own the most of the companies
Okay.
they run by dollar value.
So so if you're invested in one of those top 100 of the 500 companies, but the leader, the owner, the one who grew it is selling off their stock, you'll also sell that off then and invest somewhere else. That's kind of how you work.
That's correct. That's correct. They'd have to be selling. Um, I guess it depends on the company. So, Jeff Bezos has been selling for 20 years, but if he sold a massive part of his Amazon shares, it would definitely be reflected in our index.
Okay.
And yeah, so the reason why him specifically would have to sell a massive part is we cap the ownership at 5%. So whenever a CEO owns more than 5% of their company, we just count it as 5%, because we don't want a portfolio of just Oracle and Dell, where Larry Ellison owns 40% of Oracle and Michael Dell owns 40% of Dell. So once these leaders start selling their positions below the 5% threshold, that's when we start um, reducing the exposure to those companies.
Yeah.
Most of the time, companies get excluded from the index when a CEO retires or dies. For example, FedEx CEO Fred Smith, the founder of FedEx, he passed away. So that was a rebalance of where FedEx left the portfolio because that ownership wasn't there anymore uh, because of death. And you get um, you get retirements as well.
Yeah.
So, for example, Warren Buffett, he's still part of Berkshire, but when he does retire from the board, we'd be rotating out of Berkshire Hathaway.
Okay.
Yeah.
That's yeah, and he's been the kind of main guy for so long, it seems
Yeah.
like,
Oh,
and
absolutely.
what
Yeah.
people
A lot of
go to
people
for
don't know how
advice.
great Warren Buffett is. I could paint a perspective here. Couple things. If you invested $10,000 when he took over Berkshire Hathaway in 1965, I like to ask people to guess how much that $10,000 would be today. You wanna try to guess? I mean, just name a big number.
350,000. I don't
Um, Almost close. It's actually $380 million. $10,000
Oh my gosh.
$10,000
What?
invested when Warren Buffett took over, $10,000 would be $380 million today. And a more interesting fact is, I actually made a video about this. If Berkshire Hathaway stock went down 99% tomorrow, just hypothetically, let's say the stock collapsed 99% tomorrow, almost everything evaporated, uh, you would have still outperformed the S&P 500. So so if that $380 million collapsed 99% and you had $3.8 million tomorrow, that 3.8 million is still more than what the S&P would have produced over that same time frame. So this is how successful and a great investor Warren Buffett was. He didn't invent anything, right? He simply allocated money across the company to different organizations that produce the wealth. So he didn't physically create anything himself. So this is why he's considered the GOAT and why people study his investment philosophy. And he didn't do it
Fascinating.
by trading. He purchased stocks and held them for a very long time, and that's what created that wealth.
Yeah, that's great. And you
Yeah,
studied him extensively, it sounds like. So,
yeah,
yeah.
definitely.
Yeah.
Yeah.
Well, that is all really good advice. So if someone wants to start trading, so your ETF is OWN,
Own.
OWN.
Uh-huh. Yep.
So for and
Investing in the owners. Investing. I like to say keep the trust with the owners. So
yeah.
you know, there's a huge accountability problem within the S&P 500. Uh, so right now, BlackRock, Vanguard, and State Street are becoming the largest shareholders of most organizations. And when you get a board and leadership who don't own any stock, there's no longer any mechanism to have them removed and replaced with maybe better leadership. It used to be done by active management, so active portfolio managers would buy stock and vote for change. But because
Mm-hmm.
of S&P 500 and other passive index funds are taking extreme market share away from active stock pickers, it's creating this huge systemic problem where um, bad to mediocre CEOs are held in place because there's no way of getting rid of them. And the boards who don't own any stock have no incentive of rocking the cradle because they're all getting their board fees, and
Mm,
CEOs are getting their paychecks, and quarterly bonus, and no one there to kind of rock the ship, right? No one wants to throw rocks in a glass house. So uh, the S&P 500 is creating this huge systemic problem, and I believe that we solve that systemic problem if we could take more market share away. Um, we will reward companies where leaders own meaningful stakes and uh, not invest in companies where there's no ownership.
Yeah, that seems super wise. And
Yeah,
I think no one really likes what you described with the CEOs and boards that just get paid no matter what
exactly. Yeah,
and
I
get
like to
paid
compare.
probably.
Yeah, I like to compare a hired CEO to a zoo animal and a owner operator CEO to a wild animal. So, for example, a zoo animal gets fed every day, whether it successfully hunts or not. In the same way, a hired CEO will get his quarterly paycheck and um, quarterly bonus, and very often a golden parachute, right? But a wild animal now has to go hunt for his food, and if they don't successfully hunt, they starve. And in the same way, an owner operator feels the pain of mistakes. They feel it in their own net worth. And that's
Yeah,
what you want. You want that in the leaders you invest in. You want them to feel the pain of mistakes. Otherwise, how do you learn?
right. And you want a leader who's actually leading and not one that's
Ex-
just
ex-
takes
exactly.
because
Exactly.
it's good for them.
And yeah, so it's not just about
Hmm.
rewarding CEOs with options if they're successful. You want them to also feel the pain of
Hmm.
failure, and they only feel that when they have their own money invested in the company.
Yeah,
Yeah,
that seems brilliant.
yeah,
Really, and really just common sense too,
yeah. It's common
just very
sense. Yeah,
common sense, yeah, to do that. So thank you for making something common sense for people to
yeah,
invest money in.
yeah,
Yeah.
yeah. So if you're buying index funds, you should really think about buying one with accountability, like that we created, right? One that drives accountability across the organization, um,
Hmm.
by alleviating that systemic problem that most index funds are creating.
Yeah. So just in general, what I know you've done a lot of investing, as you know, as you're a CFA and advising on that. So what would you suggest for when people should start investing and how much, what percentage of their income? Thoughts on that?
Well, I think for the most part, you may need about 3 to 4 months, maybe 6 months of your monthly expenses in the form of cash or CDs or something, or U.S. Treasuries. Beyond that, it should all be invested. Whether it's in the stock market or other assets is up to you and your financial advisor. But if you want to get started investing, you should do it now. The more time you have in the market, the better, and
Hmm.
the more sooner you can get started learning and participating in the market, the more time you have to compound that wealth through time.
Yeah,
Yeah.
I've definitely heard that. You start when you're in your 20s versus
Oh
later,
yeah.
but if it's later, then start
Yeah.
as soon as you can.
If you have 30
So,
years in the market, I mean, you're virtually guaranteed to have a great result. Um, and the shorter time frame you have, the more um, risk you have in the result you're going to get. But over a 30-year period, you're almost guaranteed to have a fantastic result. I mean, the stock market has produced over any 30-year period in history has produced you know great wealth creation.
yeah. What other advice do you have for us?
Well, uh, I would say one thing we didn't really cover is why index funds are so great. There
Okay.
was this professor out of University of Arizona State, um, who studied all stocks across the United States over 100 years, so over a century. He looked at every single stock, and what he found was only 4% of them created the entire wealth creation of the stock market, and the other 96% matched US Treasury bills. So all the wealth gain came from just 4%. This is why it's so hard for individuals to pick stocks or even professionals to pick stocks because, you know, it's really just 4% of them making all those massive gains. Um,
Wow.
so the advice I could share is uh, don't sell stocks. Now, a lot of people know what great companies are, but most people trade out of them and they don't let those returns um, fully get compounded. So, can you imagine buying, Facebook, Apple, or Amazon, or Tesla, or any of these great companies 10 years ago and selling them when they're up 100% or something? It's a terrible mistake. So when you find a great business, you just have to hold on to it for as long as those leaders are running those companies, and you respect those leaders. Do
Hmm.
not sell. Uh, the richest, the people who got the richest off, let's say Berkshire Hathaway or Tesla, were not investors who studied the numbers of Berkshire Hathaway. Those investors trusted Warren Buffett and never sold, and that's why they got extremely rich. And the same goes with Tesla. People believed in Elon's mission and invested early on in Tesla and held all the way through, and they got rich. But it's not the people that looked at the earnings or balance sheet, or I'm not saying those figures are not important, but they're certainly less important than many people have given them credit for. What is more important is the leadership, how much they own, and how great um, they are as capital allocators. And when they're great and they own so much of it, um, you could almost turn a blind eye with at least part of your savings and just put it in them and close your eyes for 20 years. You know, as long as those leaders are good leaders and
Hmm.
own a lot of their company, you could do that.
Well, that does make sense. Yeah. Find a
Yeah,
good leader and
yeah,
keep it going.
yeah.
Yeah. Well, thank you for your time today, and that's a lot of good wisdom for us and investment. So, any parting thoughts?
No, take a look at my ETF, or go to my
Okay.
website, insideownership.com. Very easy website, insideownership.com. And yeah, look for the OWN ETF, OWN.
OWN. Okay. Sounds good. Thank you, Haren. I appreciate your time today. Thanks for your
Th-
wisdom.
Thank you.
Did you like that? You can watch more episodes here, subscribe over here. We actually have new episodes with awesome guests every Thursday, so check back in. Is that all?